Hi, it's Nick Cato with Leo Barrick. On today's episode of Tax Topics for Deal Professionals, we're going to be talking about FIRPTA. What is FIRPTA? FIRPTA are these kind of asinine rules that came into place in the early 80s, which pretty much said, look, if you're a non-US person and you own shares in a US corporation whose predominant asset is real property, we're going to tax you. The IRS will tax the foreign shareholder when they sell shares in the stock of that corporation. So that's important because the baseline rule is if you're a non-US person and you own shares in a corporation, you could sell those shares of stock and not pay tax in the US. So if FIRPTA were to apply to your company, that is material because now at the current rates, you're paying a 21% tax on the disposition of that stock to the US government when you otherwise wouldn't have had to. And so what is real property? Real property is a really vague term. It's, it can mean a lot of different things in the US tax land, but, think about things that are affixed to land and would be damaged, or that would cause damage to the land if you had to move it. That's a good general rule of thumb. Although, believe it or not, even intangible value can sometimes be treated as real property, depending on the facts and circumstances. Now, there are some investors that are exempt from FIRPTA, even though you're foreign, such as qualified foreign pension funds and certain kind of sovereign wealth funds as well. So that is something to think about as you're doing your structuring. You may be exempt from FIRPTA, but a lot of LPs are not, and it is an item that can have a material tax drag on your IRR. The other way that FIRPTA can kind of creep into your deal is not just on the exit, but if you watch some of our earlier videos on the tax treatment of distributions out of a corporation, to the extent you're making a distribution that exceeds your E&P and exceeds your basis, that is treated as a capital gain transaction. And in that transaction, you could be subject to FIRPTA on a distribution as well. And so FIRPTA can really rear its ugly head on distributions in excess of E&P and basis, and when you ultimately exit your investment. If you have any questions about this, be sure to give us a call at Leo Barrick. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.